All right, everyone, welcome. We're here to discuss, part two here of itemized deductions, chapter 5. We left off with, we're talking about deductions or gifts to charity, charitable contributions, if you will. So, some things that have changed over the last few years. It's gone from limited to 50% of your AGI, meaning now that seems very high compared to the medical expense limit of 7.5, and you're right. And this is a maximum. This is not a floor. It's not like you have to get over a certain amount. This is up to 60% now of your AGI. That's a lot of charitable contributions. Other things that they tightened up on is the idea that you could make a contribution to education institution counted as a charitable contribution, but get some benefit in return, either tickets to the football game or some other preferential treatment if you get anything in return. And that's kind of the basic idea of any charitable contribution. It just tended to be overlooked when it came to educational institutions. So they tightened that up and said, no, it's just like everything else. You get something in return. It's not a charitable contribution, or at least it's not fully a charitable contribution. If you pay $200 and get a $100 benefit, then the difference is maybe a charitable contribution, but the whole amount is not, because you're getting something in return, whether it be a parking spot, whether it be tickets, whether it be your first dibs into the freshman class of the school or something like that. Okay, so we're going to be much more cautious about what benefit we get for our charitable contributions. There's a lot of abuse about that. Okay, so these, of course, are all listed on Schedule A. Again, going roughly in order. And the amount of the deduction has a lot to do with what type of property you're donating. So our first thought is we're just giving cash to a charity, and that happens. And that's relatively straightforward and easy to account for. But some people will want to donate other things that have value, and that's where it can get a little bit more complicated. And we have to consider that possibility and the limits, and everything revolves around this limit of AGI. And that limit will depend on what type of property and who we're giving the property to. So the limitations are 60% overall. You never can have a charitable contribution more than 60% of your AGI total. But there's also 30% and 20%, depending on what the property is. So where do those come into play? Well, as long as you're giving cash and you're giving it to a public charity, and that is the types of charities that you recognize soliciting donations, Red Cross, Salvation Army, that sort of things, your churches. Those cash charitable contributions are limited to 60% of your AGI. If you give more than that, it's going to have to carry forward to next year, up to 5 years. But if you give appreciated capital gain property, and this is property that if you sold it would result in a capital gain, like stock or bonds, other investments, and you give that to a public charity, then the limit's 30%, not 60%. 30% on that. And then you can look at your cash contributions to see if, in addition, they stay under the 60%. So you always apply the lower limits first, whichever lowest limit is. So on appreciated capital gain property, it's 30%. If you give that same capital gain property to a private foundation, and that's not a public charity, that's an organization that only accepts donations for a few people, not from the general public, then it's only 20% of your AGI. Okay? And of course, if you go over, you still can, but it will carry forward for 5 years. If you don't use it in 5 years because you have more AGI in future years, then it disappears. You don't gain deduction for it at all. Okay? Now, what amount do we use when we dealing with something other than cash? So appreciated capital gain property, we get to use, for instance, if we're donating stock or real estate, the donation amount is the fair market value of the property. All right. So if you have stock worth $50,000, you donate that. Okay. The donation $50,000 fair value, and then you apply the limit of AGI that we talked about earlier. However, if it's tangible personal property, so this would most likely be some type of a antique or other collectible that you donated, a statue or something like that. If the donated property is put to unrelated use or it's just sold, then you don't get the fair market value. It's only a cost. So you have a statue in your home that you've held for many years, and it's worth a lot more money than you paid for it. So it's appreciated, capital gain property, but it is tangible. It's not stock. It's not bonds. It's physically, you can touch it and feel it. And you decide to give it to a museum. If they're going to use it in their collection, you donated it to a museum and they're going to use it in the collection, then it is a related use. And then you can use the fair market value of that donation. But if they have no need for it in their collection and they just decide to sell it, then the value that you get to use is just the cost, what you paid for it. So you don't get the benefit of the fair market value if they're going to sell it or they're going to use it other than displaying it in their charitable purpose. Now, if you have a property that is stock or any type of investment property, real estate, and you only own it for a year before you donate it, or less than a year, let's say that, then it is, again, only the cost of the asset. You don't get the fair value. So to get the best benefit of donations of other than cash, it needs to be appreciated property. It needs to be held for more than a year. And it needs to either be intangible, stock, bonds, something like that, real estate, or if it's not, they need to use it in their charitable purpose, meaning they're going to put it on display or something. Okay? So you got to hold it more than a year before you give it up. So how do you prove what you are getting for your deduction as far as charitable contributions? Okay, if it's less than $250,000, you can just use your canceled check or a receipt. If it's more than that, the organization now has to provide an acknowledgement. If it's non-cash, if it's physical property, then you're supposed to, if it's over $500, file an 8283. Okay, which is basically a outline of what you gave and how you came up with the value of it. There's specific things, especially you donate cars. You see a lot of, and less so now, but it used to be very common that organizations would ask you to donate your old vehicle. And that became somewhat abusive because the value they were putting on some of the vehicles was way too high. So now the organization actually has to send you a report of what they sold it for. And that is the amount that you're going to be able to use as your charitable deduction. So they've cracked down on some of those. You give money, you give your clothes to the Salvation Army. You can't just say that that's worth $1,000. You've got to fill out the 8283 and show that you did something to figure out that the value of what you donated was that high. Okay, so it has become more difficult to use a charitable contribution if you don't get some kind of acknowledgement from the organization. And so that's put a lot of burden on organizations as well to make sure that they send that out saying yes. And their acknowledgement is going to say something to the effect of, this person gave this money or this product or this whatever, and they didn't get anything in return. We didn't give them a seat on our board. We didn't do something like that. And so therefore they can have a charitable contribution worth this much. All right, so those are the most important itemized deductions by far that we've covered so far in the first video and this second one. But there are some things that you should at least know about. The next one is casualty losses. And this still says theft losses, but for the most part, it's not going to work as theft because it has to happen in a federally declared disaster area. But I guess if there were looting and say the things that were stolen based on that disaster area, then it would still be a theft loss. For the most part, we're talking about what's called a casualty. And it only is deductible, only can be included in your itemized deductions if it was declared as a federally declared disaster by the president, which definitely limits it, but there's still plenty of opportunities for there to be these losses. Okay? And we're talking about, and this is usually covered by the fact that it has to be a declared disaster area. It has to be sudden, unusual. It can't just be that the termites have been eating away at your foundation. We're talking about flood, fire, something very, very sudden and difficult. And we're looking at the loss that we incur after insurance. So you had property, it got completely wiped out, worth $10,000, or cost you $10,000. You have a $10,000 loss. Then you submit that to insurance. They pay you $5,000. So now you only have a casualty loss of $5,000. Okay, because you have to consider how much the insurance is going to pay. So you wait till you file with insurance to know what the casualty loss is going to be. So how do you determine the amount? Fair market value before and after. So if the property was worth $100,000 before the casualty, and is now only worth $80,000, you've got a $20,000 loss. Or if it's completely gone, okay, or the lesser amount is how much you actually paid for it. You have to try to prove this. However, it is not impossible. You do not have to necessarily get an appraisal before and after, somehow anticipating that there's going to be a casualty. You can utilize the cost to repair. So realistically, are you going to be able to say that the property was worth $100,000 before and $80,000 after casualty? Probably not. But you could show that you spent $20,000 in fixing up the property after the casualty, and that could give you a good estimate of what the reason why you spent that much money is because that's how much the value of your property had dropped because of the casualty, and you're trying to make up for it. Okay? You do it in the year that it took place, unless, of course, the year that you pay for it is different. Okay? And you have to, especially when you're waiting for insurance reimbursement, to know. Now, besides just the overall, it has to happen in a federally declared disaster area. It's got to be less than for insurance. It's got to be figured out based on the fair value of the property. Still have to take each separate casualty reduced by $100. We call that the deductible. And the total of your casualty losses have to be over 10% of AGI. So like the medical expenses, it don't do you any good until over 7.5. These losses don't do you any good until you're over 10%. Okay, reported on 4684, and then onto your Schedule A. So a lot of things that basically make that your casualty loss is not going to be deducted. So to have a casualty loss, it's got to be a federally declared disaster area. It's got to be substantial. It's got to be big and sudden, a lot of dollar amount, because it's got to be over 10%. It's got to not be covered by insurance. All right, and then it's got to be added in with all your other itemized deductions to see if it's more than your standard deduction. So you got lots of hurdles to have a casualty loss. That's why it's typically not a critical piece of your tax planning. Now there's some other itemized deductions. What was used to be referred to as miscellaneous itemized deductions is gone in the tax law. So there's some other itemized deductions, but they are very limited and have their own limits that are substantial. And there's really two that we're going to even look at. The one is by far the one that we see the most often. That's gambling losses. Okay? So gambling losses are the cost of non-winning bingo, lottery tickets, raffle tickets, anything like that, as well as losing money in a casino or anything like that. Now, when you go to the casino these days, a lot of the places will actually track your losses. But important thing to remember about any gambling losses, they are only deductible to the extent of gambling winnings. And you must report your gambling winnings as other income on your 1040. Or if you don't have any income from gambling, then you can't have any losses from gambling. I don't care how big they are. And they don't carry over. So if they're gone, if you can't use them, you can't use them. They're gone. They're gone, they're gone. So if you have gambling winnings of $1,000, then you could have, now it doesn't have to be the same gambling, meaning you could have lost it in different ways. You could have lost money on lottery and have a winner at the casino, and you can use the losses to offset the winning. But so, and again, it's only added to your other itemized deductions to see if you have, it's more than your standard. So if you don't have other itemized deductions, your gambling losses may still not do you any good, even if they are substantial and even if you have winnings to offset, use them to offset. So if you have a jackpot of 5,000, that would be gambling income. That would be the most gambling losses you could take. If your gambling losses are lower than that, then of course you can take those, but you can't deduct more than 5,000. And then if there's casualty and theft losses, like we talked about before, what a casualty loss looks like, if your property is income producing, like it's a rental property, then we could have another itemized deduction for that. But for the most part, the only other itemized deduction you come across is going to be your gambling losses. And just remember that they are limited. Run into that all the time. Client will say, well, I have all these gambling losses. And I'll say, well, where's your gambling winnings? And they'll say, oh, we didn't have any. Then I'll say, well, they're not going to do you any good. Or they do have some winnings, but not very many. And they don't have other itemized deductions to add in. So the gambling loss still doesn't do them any good. And they're very disappointed, typically, for not being able to deduct those gambling losses. Because they typically are told that they can deduct their gambling losses, which in very limited cases is true, but generally those that promise that don't know or don't explain the restrictions on the losses.